All right, everyone, welcome back to another episode. In today's episode, we're going to talk about cap rates, and in particular, who determines the cap rate, who sets the cap rate. Let's dive into it. All right, so on the agenda is first, the market does, whatever that means. The next is buyers do, as they are the ones who set the price going in. But I think if that's true, then you got to believe that the sellers do also, because they're the ones who accept any given price. And then finally is the textbook does, the academic does. And if there's a standard way of determining a cap rate, it must be this way. So we'll explore all four in a little more detail now. So let's start off with the market. So before we do, I think obviously we have to understand what is a cap rate. And I know a lot of you are kind of rolling your eyes at this because you already know, but I think it's important to start here. First, again, a cap rate is net operating income divided by price or value. And what we're really cluing in on is how is that price or value set based on a given cap rate. I think the easiest way to explore this is through some kind of example. So let's assume that there's this apartment building. You want to buy it, but you're not sure about what the cap rate is for a property like this. So one way for you to do this is to take a look at the market, right? Let's take a look at other similar apartment buildings that have sold recently with a disclosed cap rate. So maybe you have neighbor or property A. It's sold at an 8 cap. And you have property B that's right across the street and it's sold for a 7 cap. And property C and D and so on. And so you could eventually come up with an average of what similar properties to yours are selling for or buying at on a cap rate basis. So you can take the average and you can use this as a starting point to try to figure out what the cap rate can be. And this is really what they mean by the market is the one that sets it. Now, I understand that this isn't really magical in any way, right? We're kind of just surveying comps and pulling averages, but this is a tried and true way to help establish at least a range of caps. So next is the buyer does. And so if the buyer is the one that sets it, let's look at it from their perspective. Imagine you have a buyer, like this guy. That buyer wants to maximize value. That buyer wants to maximize their investment. They want to earn as big of a yield as possible. The best way to do that is to offer the lowest price. Offering the lowest price means that they are earning the highest cap rate. So let's take a look at a quick example so we can see what that means. So let's come back to this apartment building. How about we say that that buyer is offering now in this building? They offer $666,000. That works out to be a 15% cap rate at $100,000 of NOI. What if we say that the seller counters at $1.482 million? That's a 7% cap rate on $100,000. So if we look at this from the buyer's perspective, what can they do? So they have a couple choices. The first is they can stop negotiating and move on. So maybe they think that the seller's counter is unreasonable, the cap rate is too low, the price is too high, they're not willing to pay it. So they move on and they try to make another offer on another property and see how they fare. That's a choice. The next choice is they could simply accept the counter and pay the $1.42 million, effectively agreeing to the 7% cap rate return. And the last is something in the middle, right? They could try to negotiate, go back and forth, revise an offer so that the cap rate that they really earn is between the 7 and the 15, right? So one way that we could argue that buyers are the ones who set it is because they are the ones who ultimately offer and they are the ones who ultimately decide if they can follow through with that prospective purchase. Now, the same is true from the other side of the coin, from the seller's perspective. They want to ask for the highest price possible. They want to maximize proceeds to themselves. So asking for the highest price means that they're really asking for the lowest cap rate. They want to sell at the lowest going out or exit cap rate. And so what this really means is that there's got to be some middle ground, right? That they want the buyer to accept the lowest cap rate. So if we come back to this example, if the seller sells at a 7, that means that the buyer is agreeing to buy at a 7 cap. So the only way that the buyer could is if the seller was willing to accept that price. So again, you could also argue that sellers are the ones who determine the cap rate by establishing the floor on price or the ceiling on cap rate that they're willing to accept. So you could find yourself on the other side, right? You are Luke instead of Darth, and you're trying to find a way to find that middle ground between the two. The last one is the academic perspective, the textbook perspective. And so the name or the phrase that's given to this textbook approach is the band of investment method. And this is really just another fancy way of describing a weighted average cost of capital. So you'll typically see a formula that looks something like this, where we take a look at the cost of debt and how much debt you're borrowing relative to the cost of equity and how much equity you had to contribute. And what is that weighted cost between the two? So again, let's take a look at a quick example. Let's say you have a loan from a lender, 7% interest rate, 75% loan to value ratio. So that's one part of the equation. The next part of the equation is you have an investor. The investor contributes the remaining 25%, but their cost of equity is 10%. So at this point, it's basically math, right? 75% times 7% gives us 5.25. 25% times 10% gives us 2.25. 2.25 plus 5.25 is 7.75. So we can use the band of investment method, the weighted average cost of capital method, to try to serve as an arbiter, right? Like another benchmark or point of reference to help us understand what we think that cap rate could be. So overall, I think there's a lot of different ways for us to look at this, right? We could say that the market does by surveying comps. We can say buyer does by establishing the lowest price, or alternatively, the seller does by establishing the highest minimum. And we can also look at the textbook approach, the band of investment approach, to help figure out what we think the cost of capital meaning has in determining a cap rate. Now look, the truth is, I think all of them happen at the same time, and all of them factor into determining the range of cap rates. But make no mistake, it is a range, and your job is to try to get as tight of a range as possible, depending on which side of the table you're on. As a buyer, the lowest, and as a seller, the highest value, or alternatively, as a buyer, the highest cap rate, or as a seller, the lowest cap rate. So as always, I hope you enjoyed this video. I hope you learned something. Thank you for taking the time, and I look forward to seeing you on the next one. Thanks again.